The financial world breathed a collective sigh of relief on May 12, 2025. The United States and China announced a 90-day tariff truce, marking a significant development in the protracted trade war. This truce brought an immediate end to the escalating tariffs that had plagued global markets for months. The news triggered a wave of optimism, sending shockwaves through global financial markets. Stock markets worldwide, particularly in the US and Asia, responded with a resounding rally. The S&P 500 surged 3.3%, reaching its highest point since March, while the tech-heavy Nasdaq Composite Index soared by an impressive 4.4%. This positive market reaction underscores the immense relief felt by investors and businesses alike. The trade war's shadow had loomed large, creating uncertainty and hindering global economic growth. The truce, even if temporary, offers a glimmer of hope and a much-needed reprieve from the escalating tensions. The question now is whether this truce will hold and pave the way for a more permanent resolution. The impact of the trade war and the subsequent truce has been uneven across different sectors. Some industries bore the brunt of the tariffs, while others emerged relatively unscathed or even thrived in the tumultuous environment. Manufacturing, retail, and technology companies heavily reliant on Chinese imports faced significant headwinds in the months leading up to the truce. Supply chain disruptions and rising input costs squeezed profit margins and hampered growth. Chip makers in particular experienced heightened volatility due to semiconductor export restrictions. However, the truce announcement brought a wave of relief to these battered sectors. Luxury goods companies, automakers, and small-cap US-focused firms, which had suffered significant declines, saw their fortunes reverse. Luxury giants like Hermes and LVMH experienced a resurgence, as did automakers like Stellantis and Ford. Small-cap companies, often seen as a barometer of the domestic economy, also benefited from the easing trade tensions. Bitcoin, the world's leading cryptocurrency, has long been touted by proponents as a safe haven asset, a digital gold that can weather economic storms. However, its price movements during the trade war and subsequent truce have reignited the debate about its true nature. Initially, Bitcoin surged to $105,700 as news of the truce broke, reflecting a knee-jerk reaction to reduced global risks and a surge in ETF inflows. However, it quickly retreated to $102,000 as investors booked profits and shifted their focus back to traditional equities. This close correlation between Bitcoin and the stock market has cast doubt on its safe haven status. A true safe haven asset would typically exhibit an inverse correlation with risk assets, appreciating in value when markets tumble. Bitcoin's recent performance suggests it behaves more like a risk-on asset, moving in tandem with stocks and other traditional investments. This raises questions about its long-term role in a diversified portfolio. Gold's uncertain future caught between easing tensions and macroeconomic risks. Gold, the quintessential safe haven asset, experienced a surprising decline following the tariff truce announcement. The precious metal, often seen as a hedge against uncertainty and inflation, fell 3% to $3,231 per ounce, as investors rotated out of safe havens and into riskier assets like stocks. Several factors contributed to gold's decline, including a stronger US dollar, easing inflation fears, and reduced demand for safe haven assets. The truce, by reducing global uncertainty, diminished gold's appeal as a hedge. However, the long-term outlook for gold remains uncertain. While the truce has eased immediate tensions, geopolitical risks and macroeconomic headwinds persist. A resurgence of trade tensions, a flare-up in geopolitical hotspots, or a spike in inflation could reignite demand for gold, pushing its price higher. Navigating the road ahead, short-term optimism meets long-term uncertainty. The 90-day tariff truce has injected a much-needed dose of optimism into global markets. Investors have cheered the easing of trade tensions, sending stocks soaring and boosting risk appetite. However, the road ahead remains fraught with uncertainty. In the short term, technology and exporter stocks, which stand to benefit most from reduced tariffs, could see further gains if the 90-day talks progress constructively. However, any signs of a breakdown in negotiations or new disputes arising could quickly evaporate the recent market rally. The long-term outlook hinges on several macroeconomic factors and potential wildcards. China's economic policies, particularly its stimulus measures to counter a manufacturing slump, will also play a crucial role in shaping the global landscape. Investors should remain vigilant, carefully monitoring developments and adjusting their portfolios accordingly. The trade war truce may have provided a temporary reprieve, but the path forward remains uncertain and demands prudent navigation.